Some investors always seem to be one step ahead. They're the ones who consistently outperform the market, achieving returns that most people only dream of. But how do they manage to stay ahead of the game? What strategies and principles do they follow that set them apart from the rest? In this video, we'll break down the key habits, strategies, and mindsets that allow top investors to consistently beat the market. Whether you're new to investing or looking to refine your approach, these insights will give you a clear understanding of what it takes to achieve sustained success in the world of investing. The mindset of top investors. A crucial element of successful investing is having the right mindset. Top investors approach investing with a specific attitude and set of beliefs that guide their actions. They don't chase after quick profits or let short-term market fluctuations dictate their decisions. Instead, they focus on long-term value and sustainable growth. Let's delve deeper into what sets their mindset apart. Understanding your investment. To excel in investing, it's essential to have a deep understanding of what you're putting your money into. This means adopting a business approach to your investments. Top investors don't just glance at stock prices, they dive deep into understanding the companies they invest in. They analyze business models, competitive advantages, and industry dynamics. Understanding a company's business model. A company's business model is the foundation of its success. It describes how the company generates revenue and profits. Understanding this model helps investors evaluate whether a company has a sustainable competitive advantage. For instance, does the company have a unique product or service that differentiates it from competitors? Does it operate in a market with high barriers to entry? To gain a thorough understanding, investors examine various aspects of the business model. This includes the company's revenue streams, cost structure, and profitability. They assess how the company's products or services fit into the market and whether they address a real need. Analyzing these factors helps investors gauge the company's long-term potential. Conducting thorough research and due diligence. Top investors conduct meticulous research and due diligence before making investment decisions. They evaluate key metrics such as earnings growth, return on equity, and debt levels. Management quality is another critical factor. Investors look for experienced leaders with a track record of success. They assess the management team's ability to execute its strategy and adapt to changing market conditions. Strong leadership can significantly impact a company's performance and, consequently, its stock price. Patience and discipline. Patience and discipline are core traits of successful investors. They understand that the stock market is inherently volatile and that short-term price movements can be misleading. Instead of reacting to daily market fluctuations, they focus on the long-term potential of their investments. Avoiding emotional reactions. Emotions can cloud judgment and lead to poor investment decisions. Top investors avoid making impulsive decisions based on fear or greed. Instead, they stick to their investment strategy and remain disciplined, even during periods of market turbulence. This approach helps them avoid the pitfalls of emotional investing, such as panic selling or chasing after hot stocks. Long-term perspective. One of the most compelling reasons for adopting a long-term perspective in investing is the power of compounding. Compounding is the process where returns on an investment generate additional returns over time. The longer you stay invested, the more pronounced the effect of compounding becomes. The magic of compounding. Let's consider an example to illustrate the magic of compounding. Suppose you invest $10,000 in a stock that yields a 10% annual return. After 1 year, your investment will grow to $11,000. In the second year, you earn 10% on $11,000, resulting in $12,100. This process continues, and your investment grows at an accelerating rate due to compounding. The effect of compounding becomes even more significant over extended periods. If you leave your investment untouched for several decades, the growth can be substantial. This is why top investors emphasize the importance of holding quality investments for the long term. By allowing compounding to work its magic, investors can achieve remarkable returns. Avoiding short-term thinking. Short-term thinking can undermine long-term investment success. Investors who frequently buy and sell based on short-term market movements often miss out on the benefits of compounding. Additionally, frequent trading can lead to higher transaction costs and tax implications. By maintaining a long-term perspective, investors can ride out market fluctuations and benefit from the overall upward trend of the market. Diversification. Diversification is a fundamental principle in investing that helps manage risk. By spreading investments across different asset classes, sectors, and geographies, investors can reduce the impact of a poor-performing investment on their overall portfolio. The principle of diversification. The principle behind diversification is straightforward. Don't put all your eggs in one basket. Diversifying your investments ensures that a decline in one area of the market doesn't significantly harm your entire portfolio. For example, if you invest in stocks, bonds, real estate, and international markets, the performance of any single investment is less likely to affect your overall returns. The limits of diversification. However, there is such a thing as over-diversification. When a portfolio is spread too thin across too many investments, the benefits of diversification diminish. Research suggests that the optimal number of positions in a diversified portfolio is around 20. Beyond this point, adding more investments offers diminishing returns in terms of risk reduction. Ray Dalio's Holy Grail and Warren Buffett's Insights. Ray Dalio, the founder of Bridgewater Associates, emphasizes the importance of diversification in his Holy Grail concept. He argues that a well-diversified portfolio can achieve higher returns with lower risk compared to less diversified portfolios. Dalio's approach involves diversifying across asset classes that have low correlations with each other, such as stocks, bonds, and commodities. Warren Buffett, on the other hand, has highlighted the benefits of focused investing. While he acknowledges the value of diversification, he also stresses the importance of understanding and concentrating on investments in which one has a high degree of confidence. Buffett's approach involves investing in companies with strong competitive advantages and holding them for the long term. Focus investing. Focus investing is a strategy that involves concentrating investments in a small number of high-conviction stocks. This approach allows investors to take larger positions in companies they believe have significant growth potential. While focus investing can lead to higher returns, it also carries higher risk. The ideal approach. Focus investing is ideal for experienced investors who have the resources and expertise to conduct in-depth analysis. These investors can identify a few high-quality opportunities and allocate substantial capital to them. This approach requires a deep understanding of the companies and industries in which they invest. Balancing focus and diversification. For the average investor, focus investing may not be practical due to limited resources and expertise. Diversification remains a sensible strategy for managing risk. By diversifying up to an extent, investors can protect themselves from significant losses while still benefiting from potential gains. The key is to find a balance between concentration and diversification based on individual risk, tolerance, and investment knowledge. Case studies of top investors. Let's examine the track records of some top investors who have consistently beaten the market. Warren Buffett. Warren Buffett, known as the Oracle of Omaha, is one of the most successful investors of all time. He began his investment partnership in 1956 with just $105,000 in capital. Over the decades, Buffett built Berkshire Hathaway into a global conglomerate with a market capitalization exceeding $1.01 trillion. His disciplined approach, focus on intrinsic value, and long-term perspective have resulted in an average annual return of over 20% for Berkshire Hathaway's shareholders. Peter Lynch. Peter Lynch managed the Fidelity Magellan Fund from 1977 to 1990, delivering an average annual return of 29.2%. Under Lynch's leadership, the fund's assets grew from $18 million to $14 billion. Lynch's investment philosophy was centered on thorough research, understanding businesses, and identifying undervalued stocks with strong growth potential. His success exemplifies the power of informed and disciplined investing. Charlie Munger. Charlie Munger, Warren Buffett's business partner, has played a crucial role in shaping Berkshire Hathaway's investment strategy. Munger's investment philosophy emphasizes the importance of mental models, multidisciplinary thinking, and patience. He advocates for focus investing and believes that concentrating on a few high-quality investments can lead to exceptional returns. Munger's approach highlights the value of deep analysis and a long-term perspective. The role of technology in modern investing. While technology has transformed many aspects of investing, top investors often rely on fundamental analysis and simple tools, rather than advanced algorithms or robo-advisors. Using spreadsheets and stock screeners, spreadsheets, Excel, and stock screener apps are valuable tools for investors. Spreadsheets allow investors to create financial models, track portfolio performance, and analyze investment scenarios. Stock screeners help filter through thousands of stocks based on specific criteria, such as valuation metrics and growth rates. Avoiding over-reliance on technology. Top investors like Warren Buffett often avoid complex algorithms and robo-advisors. Buffett famously uses a calculator and his extensive knowledge of businesses rather than sophisticated technology. This approach emphasizes that while technology can aid analysis, it's the investor's understanding and judgment that ultimately drives success. Risk management. Effective risk management is crucial for long-term investment success. Top investors employ several strategies to manage risk and protect their portfolios. Margin of safety. The margin of safety concept involves buying securities at a price below their intrinsic value. This provides a cushion against potential losses and enhances the likelihood of positive returns. By ensuring that there is a significant margin of safety, investors can mitigate downside risks and improve their chances of achieving favorable outcomes. Avoiding leverage. Top investors typically avoid excessive leverage, which involves borrowing money to invest. While leverage can amplify returns, it also increases the risk of significant losses. Warren Buffett, for example, prefers to invest with cash on hand rather than using borrowed funds. This conservative approach helps protect his portfolio from adverse market conditions. Learning from mistakes. Even top investors make mistakes, but their ability to learn from them sets them apart. They analyze what went wrong, adjust their strategies, and avoid repeating the same errors. This continuous learning process is crucial for refining investment approaches and achieving long-term success. Conclusion. Consistently beating the market requires a combination of the right mindset, a deep understanding of investments, a long-term perspective, and effective risk management. By following the principles and strategies used by top investors, you can improve your chances of achieving sustained success in the stock market. Remember, investing is not about quick wins. It's about building wealth over time through careful planning, patience, and discipline. Whether you choose to diversify your portfolio or focus on a few high-conviction investments, the key is to stay informed, stay patient, and stay committed to your investment strategy. By adopting these practices, you can increase your likelihood of outperforming the market and achieving your financial goals. Raise your IQ with cutting-edge info, insights, and analysis. Visit and subscribe for free at the link below.